This video is for educational and informational purposes only. It reflects personal opinions and does not constitute financial or investment advice. Trading Forex involves risk and may not be suitable for all investors. Always do your own research or consult a licensed financial advisor. Your trading decisions are your responsibility. Welcome back to Forex Mastery. So far, we've laid the foundation. What Forex is, how pairs work, how trades are placed and managed. Now it's time to develop your trader SI, to read the market visually using charts, candlesticks, and price action. This episode is all about understanding what the market is telling you through price. You'll learn to read charts, recognize candlestick behavior, spot support and resistance levels, and understand the basics of trend direction. No clutter, no indicators, just price movement and pure market behavior. Let's begin with charts. Trading chart shows how a currency pair's price moves over time. Most platforms offer different styles, but the most commonly used is the candlestick chart. Each candlestick represents a specific time period, like 1 minute, 1 hour, or 1 day. The open, the high, the low, and the close. The thicker part of the candle is the body. If the close is higher than the open, it's usually green. That's bullish. If the close is lower, it's red bearish. The thin lines above and below the body are called wicks, or shadows. They show how far price moved within that candle's time period. Why is this important? Because candlesticks show momentum, indecision, rejection, and reversal. Visually, a candle with a small body and long wick may mean price tried to push higher or lower, but failed. A big candle with no wick may show strong one-sided momentum. Reading this price behavior gives you insight into who's in control, buyers or sellers. Let's look at some common candlestick patterns. The Doji, where open and close are nearly the same, suggests indecision. Neither side is clearly in control. A doji after a strong trend might signal a pause or reversal. The engulfing pattern is where one candle fully covers the previous one. A bullish engulfing follows a downtrend and signals strong buying. Bearish engulfing appears after a rise and suggests strong selling pressure. Then there's the pin bar, a small body with a long wick. A long lower wick, for example, means price was pushed down but rejected that level and closed higher. This often signals a possible reversal when it happens at key support or resistance. Speaking of support and resistance, let's simplify it. Support is a price zone where buyers consistently enter the market, preventing further decline. Resistance is where sellers step in and stop price from rising further. Think of support as a floor and resistance as a ceiling. Price often bounces between them until it breaks out. These zones aren't precise lines. They're areas. They become more reliable the more times price reacts to them. When support breaks, it can become resistance. When resistance breaks, it can become support. This flip is a key behavior in Forex, and it creates smart trading opportunities. Let's say your USD rises repeatedly to 1.1000 but fails to break higher. That's a resistance level. If price finally breaks through and holds above 1.100, that area may now act as support. If price retests that level and bounces, that's a classic setup. Now let's talk trends. A trend is a general direction of the market. An uptrend is a series of higher highs and higher lows. A downtrend is lower highs and lower lows. A range is when price moves sideways between support and resistance. Trends form because of market sentiment, optimism or pessimism over time. Learning to identify and respect the trend is one of the most powerful habits you can develop as a trader. Here is a simple method. Draw a line connecting two or more swing lows in an uptrend or swing highs in a downtrend. That's your trend line. If price respects the trend line and bounces repeatedly, the trend is intact. When it breaks the trend line and confirms with lower highs or higher lows in the opposite direction, the trend may be changing. Let's tie this into a trading scenario. You notice GBP USD has been forming higher highs and higher lows. It recently bounced from a support zone and formed a bullish engulfing candle. That's price action, trend direction, and a candlestick pattern all confirming a potential long trade. You enter with a stop loss below the support and your target near the next resistance. That's what we call confluence. When multiple factors align to increase your trade S probability of success. Confluence is key. Don't trade based on a single candle or a random zone. Look for a reason behind the move, and let your setup stack the odds in your favor. Another powerful concept is multi-timeframe analysis. Don't only look at one chart. The market moves in waves, small inside big. What looks like a reversal on a 15-minute chart might just be a pullback on the 1 hour. Always start with a higher time frame, daily or 4-hour. To understand the trend, then zoom into the 1 hour or 15-minute to find a clean entry. Here's a practical example. On the daily chart, you see your USD in an uptrend. On the 4-hour chart, price is pulling back to a previous resistance zone that now acts as support. On the 1-hour chart, a bullish pin bar forms, that S3 timeframes agreeing, and that S how professional traders build confidence in their entries. You don't need a dozen indicators. You need structure, confirmation, and consistency. Price is the most honest indicator. Everything else, RSI, moving averages, MACD is derived from it. That's why mastering price action is so valuable. It's simple, elegant, and powerful. Let us wrap this episode with a core trading mindset. React to what the market is doing, not what you want it to do. Price action gives you evidence. Support and resistance give you structure. Candlesticks give you clues. When you combine those elements and back it with good risk management, you're trading intelligently, not emotionally. To recap, candlesticks show open, high, low, and close, and tell a story about market sentiment patterns like Doji and Engulfing. And pin bars are signals, especially near key levels. Support and resistance are zones where market behavior often repeats trends are directional flows. Trade with them, not against them. Confluence and multi-timeframe analysis increase your edge and price action. Above all, helps you trade what's real, not what's imagined in the next episode. We'll dive into indicators, how to use them wisely, and how to avoid overcomplicating your strategy. This is how you build your edge, visually, logically, and step by step. From zero to hero, this is Forex Mastery.